A retail trader wants to buy a stock. He clicks buy, and the position is filled. Now imagine a fund wants to buy $50 million of that same stock. It cannot simply push the entire order into the market at once. A buyer that large can reveal itself, consume available liquidity, and begin moving the price against its own execution. Suppose the stock is trading near $20. There may be plenty of shares available for a small order, but not enough for a fund trying to acquire millions of shares. As liquidity near one price is consumed, later executions can occur at progressively different prices. Buying too aggressively can therefore increase the institution's own execution cost. So the problem changes. The question is no longer simply, do we want to buy? The question becomes, how do we acquire a large position without advertising the entire order to everyone else? Big money has to behave differently because size creates market impact, information leakage, and larger execution risk. One common solution is to break a large parent order into smaller child orders, execute them gradually, route them across venues, adjust the pace, and respond to available liquidity. What looks like hundreds or thousands of ordinary executions can therefore be part of one much larger institutional execution objective. This gives us our first important rule. You cannot look at one green candle and declare that institutions are buying. A candle tells you what price did. Volume tells you how much trading occurred. Neither automatically identifies every participant or intention. We are looking for evidence consistent with large execution, not magical confirmation. Markets even contain order types built around this visibility problem. Reserve or iceberg-style orders can display only part of the total quantity, while additional size remains non-displayed. As the visible portion trades, more quantity can replenish, so the liquidity you can see on the screen is not necessarily the full liquidity available. Institutions can also use off-exchange trading venues, including dark pools. These venues do not publicly display the same pre-trade order information as a traditional lit exchange. They were developed in part to let large buyers and sellers seek execution with less information leakage and less immediate market impact. And now we arrive at the useful question. If large participants try not to reveal their full intentions, what evidence can still leak into price and volume? Not certainty. Footprints. We can measure how price responds to trading pressure, whether levels are repeatedly rejected, whether ranges contract, and whether money flow begins to change. Imagine sellers repeatedly hitting bids. Volume remains active, but after the initial decline, each new wave of selling produces less downward progress. Someone, or several participants, keeps taking the other side. Traders often describe this behavior as absorption. The important information is not the story about who is buying. It is that selling is becoming less effective. High volume during a collapse is not automatically bullish. Sellers may simply be overwhelming buyers. What becomes interesting is the relationship between effort and result. If substantial trading activity keeps occurring, but price has increasing difficulty moving in the same direction, the character of the auction may be changing. Volume matters only in context. Footprint number 1 is declining downside efficiency. The first selling wave produces a large price drop. The second produces a smaller drop. The third produces very little additional downside, even though activity remains elevated. Selling still exists, but its ability to create lower prices is weakening. That change in efficiency is measurable. Footprint number 2 is repeated rejection of lower prices. Price probes beneath an area and closes back above. Later it tests the same region again and is rejected again. One wick means very little. Repetition becomes more interesting because the market keeps testing lower prices and repeatedly fails to remain there. Footprint number 3 is unusual activity without proportional price displacement. Imagine 2 periods with similar trading volume. In the first, price travels several percent. In the second, price barely moves. Something about the liquidity landscape has changed. This still does not identify the buyer, but it tells us transactions are being absorbed differently. The fourth footprint is a transition. Strong selling arrives, activity spikes, and then instead of continuing downward, price begins to stabilize. Volatility contracts. Downward momentum stops expanding. The market starts accepting prices inside a relatively narrow area. That shift from expansion to stabilization can be more informative than the volume spike by itself. This phase is visually unimpressive. No giant breakout, no 20% candle, no viral headline, just repeated trading inside a contained area. But if a large buyer is trying to acquire inventory without chasing price, dramatic movement is not necessarily what we would expect during the building phase. Quiet markets can still contain important information. This is where smart money content often goes too far. A wick below support does not prove a hedge fund hunted your stop. Sideways price does not prove accumulation. High volume does not prove institutional buying. Markets contain many participants with different motives. Our job is not to invent a story. Our job is to measure evidence. So instead of drawing a box and assuming big money lives there, we can quantify the behavior. Is downside progress shrinking? Is relative volume abnormal? Is money flow improving while price remains depressed? Are lower prices repeatedly rejected? Is volatility contracting after the selling event? Is price accepting or refusing the new low? Those questions produce measurable variables. Any single variable will generate false signals. So instead of asking a binary question, are institutions buying yes or no, we build an evidence score. One clue is weak. Several independent behaviors agreeing at the same time are more interesting. The goal is not certainty. The goal is a stronger, more disciplined estimate of market state. Imagine price has been falling for hours. It makes another low, but the new low is only marginal. Relative volume increases. The candles tighten. Lower wicks begin appearing. Money flow starts improving before price has actually reversed. No single observation proves anything. Together, however, they describe a market behaving differently from 20 bars earlier. But detecting possible accumulation and entering a trade should not be the same event. Evidence can build while price continues falling. So we separate state detection from trade confirmation. First, the market earns an accumulation score. Then price must demonstrate that buyers are actually beginning to gain control. Detection tells us where to pay attention. Confirmation tells us when conditions changed. Confirmation could be a reclaim of local structure, a break above a short execution range, stronger closing location, expansion out of compression, or another measurable transition showing that buyers are gaining control. This matters because without confirmation, an accumulation detector can simply become a very sophisticated way to keep buying falling knives. Now flip the framework upside down. Strong buying occurs. Volume remains elevated, but each new wave produces less upward progress. Higher prices are repeatedly rejected. Momentum weakens beneath apparently strong price action. Money flow deteriorates. That can be evidence consistent with distribution or supply-absorbing aggressive buying. Same framework, opposite direction. And this is the interesting part. Every behavior we just described is measurable. That means we can build an institutional activity engine that does not pretend to see a hedge fund's account. Instead, it measures how closely current market behavior resembles the footprints we would expect from absorption, accumulation, distribution, or neutral conditions. Evidence, not mythology. So the next time price reaches an important area, do not immediately ask whether smart money is buying. Ask better questions. How much trading effort is occurring? How much price movement is that effort producing? Are lower prices being accepted or rejected? Is momentum becoming more or less efficient? Is money flow confirming price or quietly disagreeing with it? Most importantly, are several independent pieces of evidence beginning to tell the same story? In the next video, we will build the institutional activity engine and define those measurements one by one. The goal is not to guess what institutions are thinking. The goal is to measure the footprints large trading activity can leave behind.